LTV.
Got you. Okay. So now my question then, if that's the case then, so the formula to actually get that down would be take whatever the house is appraised at, say $1 million for the purposes of this example, and whatever the 80% of that would be, in this case being the 800,000, you then grab that 80% of the 800,000 and subtract the owing on it.
Exactly.
And that is what you're able to get as a HELOC, essentially.
Yes.
So then now that's part one of the question. Part two being, with that now $500,000 in this hypothetical scenario, can I not go and grab that and put that, say, as a down payment in two separate properties for $250,000 each?
Yeah, there's no restriction against it. The question is gonna be, can you qualify?
Right, because then you still have to sustain those other mortgages.
Yeah, there's different ways to qualify. There's different strategies.
But if you're putting a down payment at that level, wouldn't automatically that kind of get thrown? Because that's over 20%. I mean, if you're putting $250,000 on $1 million home, that's 25%.
You're saying
right?
that should allow you to qualify?
I'm assuming it would definitely help, right? Or if not allow you to qualify, yeah.
Well, there's three main things people look at, or not people. There's three main things banks look at when they approve you for a mortgage: your down payment, which you have in this case, your credit score, and if you can qualify with income. That could be personal income. That can be income from the property itself. So just having the down payment and perfect credit alone doesn't mean you're going to qualify. I had a client who had great credit, 890, solid down payment. He has liquid assets, cash outside of his down payment, but he's on medical leave, approved every 6 months, $2,000 a month.
So his income to debt ratio is just not good.
Right. However, there are investors who buy more than 4, 5, 6, 7, 8 properties. And after a certain point, their personal income is not going to sustain the debt, right? So there are lenders who look at the NOI, the net operating income of the property itself, as opposed to the personal income, right?
Right.
It's what's called a commercial mortgage.
Right.
And yeah, they look at the rent compared to the mortgage.
But why would it be a commercial mortgage if it's, let's say, a residential home that you plan on renting out? So again, for the purposes of the example, I got $1 million home, $800,000 is 80% of it that I can get a HELOC for. I owe $300,000, so $500,000 is really what I'm working with here. I then go ahead and grab that $500,000, split it into two, $250 here, $250 here, to buy another, two $1 million home each, right? You ever play blackjack? Split the cards here. So now you buy that $2 million homes, like $1 million here, $1 million here, 25% down payment on each.
Yeah.
And now, if the purposes of those homes is to rent those homes out, wouldn't they have a better, I guess, way of approving me, because it would no longer be my primary residence. And of course, the goal here would be to avoid capital gains. So I would make sure that I, hold those properties for at least a year, and during which time, if I'm cash flowing those properties, don't the bank look at the estimated, potential cash flow of those properties and leverage that against potentially approving me for those properties?
They do. The difference between residential and commercial mortgages is the way they underwrite, the way they approve you.
Right.
So residentially, they'll look at your personal income plus about 50% of whatever the expected rent is.
50%.
50%, not all of it. You would think, well, I'm going to get $2,000 a month. Why can't I use that? That's logically thinking, right?
Yeah. Well, prepare for the worst, hope for the best, right?
On a commercial mortgage, they're more realistic. They look at the full rent. They have what's called a DSCR, debt service coverage ratio, which means the rental income, the net operating income after all expenses, insurance, repairs, has to cover at least usually 1 or 1.2 times the mortgage. That's why you see investors scaling to 100 plus properties, because they are being underwritten commercially, not on the residential side. It's a big difference in terms of the way it's approved, the time involved. It's much more complex, but I don't do commercial mortgages, to be honest with you. I do residential. So I do have clients who buy duplexes, triplexes, but one of my clients maybe has 10 properties, but I usually stay away from that.
Is that the guy in Ancaster?
Ancaster, no. It's an old Jewish guy that I know. And it was a headache of a file, because he co-signed on his kids' mortgages, but he doesn't own them. So he was a guarantor.
Yeah.
So on his credit report, I see 10 mortgages.
Does that make him a liability?
Huge. No bank is going to approve him. I was like, Abe, I can only get you approved with private. And he was shit out of luck. He's a real estate developer, so some years he had good income, some not. But I try and stay away from those clients.
Right.
Anytime someone says, "Oh, I have 6 properties, I want to buy my," Aubrey, can you help me? Yeah, I'm going to have to charge you a lot, because I have to spend 6 times as much time on this property, as this file, as I would if I'm doing someone who's just buying their first home.
Right.
So
For sure.
I stay away from those. But if you can ask me about That's why I know a bit about commercial mortgages, but if someone says, Aubrey, I want to buy an 8-plex, anything more than 4 units, I don't touch.
Really? So
I refer out.
Okay, but a duplex is just a 2-floored building. It could still have 8 units in it. If
Duplex is easy. You know Johnny Baskin, the guy who did the website for Dr. Green?
Yes. I was like, that name sounds familiar.
He just bought a home in New Brunswick, a duplex.
Okay.
And he's a business owner, doesn't claim a lot of income. But I got him a residential mortgage in New Brunswick, and they used the rental income, and they got him approved.